What's happening, guys? I hope everybody had a fantastic weekend. We've got another Sunday video coming at you guys for March 20th and the week ahead. It's all about banks. Banks. We've got financial crisis potential. We've got regional banks going under. We have national banks getting pressure. We've got headlines saying it could be 200 to 500 bankruptcies. I mean, it's not good. And there's been headlines last week that it's nothing like 2008. It's almost over. It's not really that big of a deal, et cetera, et cetera, et cetera. Time fixes everything. 2 days, 3 days is not time. So be cautious, having some sort of conviction play. There's people that are buying these regional banks because they were just 120 and now $7 makes sense to them. There's people that have been promoting $65 and $120 targets on FOMC, all Friday. And I got into a Twitter engagement with them and just kind of said, hey, it's not about that right now. Like, we need to make sure it's not a zero first before we can put a 65 or $120 target on it. The thing about the national banks is, what if there's no more buybacks? What if there's no more dividends? What if they start pulling back on all of these things that analysts have built into their prices, right? So maybe, it's not going to have this crazy exposure. However, the underlying investment, the underlying thesis as to why it should be where it was has actually changed. So nobody knows. And stop acting like you do. That's really the easiest way to trade this market. It's a trader's market. If you're going to try to position for something long term and you get bent out of shape because it's down 35% the next day, well, it's a long-term investment. Don't worry about it. But if you're going to try to day trade this stuff and hold it overnight and play, and try to figure out what it's going to do, we're one headline away from either direction of different things. And that's not, in my opinion, good risk management. It's fine if you want to dabble here and there. And just like for me, if I was going to trade the regionals long, I would do so either as an option, meaning take what I would want in an option, which it would have worked. In hindsight, looking back, the thought process of treating, say, 10 banks as an option, and maybe you put 10 grand in a piece, right? Instead of putting 100 grand into one name, you put 10 grand across 10 different ones. And God forbid one halts, at least the other 9, if they were going, you ended up making that double or triple because a lot of them did triple off the lows before coming back in 50, 60, 70% again. So just be aware that right now there is ridiculous risk. And it's all good as long as there's no halt. But what if there's a halt? Are you okay with that? Are you okay with losing that amount of money? And if the answer is no, then I don't care what you could have made. It's all about what you're willing to risk. And if you're not willing to risk that, then don't play the game I shoulda, coulda, woulda, because it's not reality. It's all easier after the fact. It's all easy after you see it, And so for me, my game plan and what we discussed last week was nationals is where the action is for me. And we had plenty of action. Schwab was a huge trade. Off the gap down and reversal, and off the gap up and reversal. Got it both ways. Bank of America was another, JPM, Citigroup. I did not trade those, but those are extensions of the whole national, kind of basket. Compared to the regionals, where I will trade FRC and WAL and PACW. Those have been kind of my focus 3 for the basket. But if I wanted long side exposure, you've got DPST, KRE, KPE, and then you're in an actual ETF rather than having that single name exposure. So you still have exposure, but just not single name exposure. So, if one goes to zero, at least, the index is not going to go to zero. Yeah, it's probably going to take a hit, but your money's not gone in a halt. So anyway, again, there's a lot of people with a lot of opinions rolling around, and it's just like anything. Nobody has any idea. Is somebody could have the best thesis, and then a headline hits the next day, and it's done, right? So just be cautious, kind of having that mentality that it's come in too far. Time fixes everything, And a couple days, a week, 2 weeks is not time. It's going to take time to let this kind of go through the system and see what other banks fail, see what other companies might fail. There's going to be a lot of ripple effects, and it's bigger than you think. And we had news this weekend on CS, which is a big deal. And Swiss UBS Bank was going to buy them or offer to buy them for basically $1 billion. That's not good. That's not good at all. So the fact that these conversations are happening shows you that there's a lot more going on than what the headline suggests. So just be really, really cautious out there. This week we have an interview coming out with Kim Ann Curtin. For those of you guys that went to Traders for a Cause, you met her. She was a hit. A lot of people enjoyed sort of the conversation and the thought-provoking, thought-provoking, not webinar, speech that she gave, and really made you kind of think about, what do you want from this, and how do you prepare for this, and what really matters to you as an individual. Everybody's going to be checking different boxes because we're all made up differently. So, what I may find is the happy check mark, and what I may find as success may not be yours. And so being able to kind of identify that and make sure that you're going down your own path and going down, what makes you the best version of yourself, I think it's really important. And I think that's what she really hits the nail on the head with. So, making sure that you are fulfilling what you want out of this. And so we've got her interview coming out tomorrow. That'll be around 6 p.m., I think, unless we do it a little bit earlier. And then for everybody that is part of Investors Underground, we have a course dropping with her. So it's no additional charge. We just created it after Traders for a Cause. She had come into the room a couple times. We had her do a few webinars. She got kind of a feel for our community. And then we did basically a product. I forget if it's a 5 or 8 part series, something like that. But it's going to be great. And so we'll launch that before or on Wednesday. So for those of you guys that are in IU, it'll just be on the dashboard, just like all the other ones that we've done. So other than that, one mistake I made last week, pretty good week overall. Some really good action. I'm not trying to kill it. It's adding up for sure. These types of moves, but you can always go back in hindsight, like I said. In the regionals, yeah, there was some major bounces. It would have been nice, but what if? So I did what I could with the national banks, with the regional shorts. I didn't try to be a hero. I didn't try to nail the entire move. I took the trade. It worked. I moved on. I waited for the next big setup, and I tried to stay out of and wanted to focus on the bigger picture type moves and be able to take advantage of that and move on. However, on Thursday, everything that I used to do came back, and on AMD, I just started to have the blinders, and I talk about not having blinders off the open because you miss here, and you just so focused on this one name. And AMD, I had great entries, great covers, great entries, great covers, and the lines worked perfect, 94.50, 95.10, 96. I mean, it was perfect. However, I had a bias that I was trying to work into a position so that when it did break, I could scale up and really let it work for me. And because I let that bias play into my trade, no matter how good I did on entries and exits, I still had a little bit of a core, and it just took away the whole trade. So, I worked all day for nothing. I actually ended up losing on it overall. But the point is that had I just waited for that one line to crack, to let my bias work, I wouldn't be in the trade at all. I wasn't waiting for that line to crack. I was actively trading it in and out, in and out, in and out, which is not what I try to do. And so anyway, I figured that out by Friday. I didn't do it. And I was very much aware of it. But unfortunately, every now and then it slips back in. And So that was one thing that I want to make sure that I don't repeat this week. It's very easy to do when you come to the market. Maybe there's not an A plus setup, so you start to really focus in on this one name. You get a good read on it, and again, you let a bias kind of take you out of the trade. So don't do that. What else do we have? We talked about banks. Talked about FRC. FRC, really good warning. Look, it could have gone up, could have gone down, but the people that are buying it and swinging it and focusing in on these high price targets, the entire industry has changed. It's not what it was anymore, and it's going to take a lot of time for that to get back. So just be cautious of that. I think that there's a time to trade, and that's right now. At the same time, just because things appear cheap, don't pretend you know what you're doing. Don't just shift gears from everything that was working to now I'm going to be a banking expert. These things are undervalued, they're oversold, they need to bounce, they're worth X, this or that, whatever. You don't know, neither do I. So don't pretend that you do. And for whatever reason, these types of situations makes everybody a pro. They all know the answer. They all know what's going to happen. But the reality is you're one headline away from being wrong. So it's just not worth it. Just be a trader when it's time to be a trader. All right, let's get into the questions that were sent in. This market is choppy and hard. Maybe just talk about that. Reminders that mindset works, proactive covers if the market's going to reread that. Maybe just talk about that. Reminders of what mindset works, proactive covers, if that's the market we are in, and so forth. I got it. Correct. So, it is a continual reminder of what type of market we're in. If you're trading small caps, and I'm going to go over that right before the rest of the scan, but if you're trading small caps, the market that we're in right now, if there's only one small cap going, you should assume that that is going to be extremely crowded. THMO we had this week. We had, what else do we have? ENZ on Friday and LIPO on Thursday, right? So all of those came in, nice and easy fades. 10, 11 a.m. starts the base, right? So I'm going to go over that because we went over that the last couple of weeks, but you can see how it works and how to stay away in this current market environment. But like the tweet said, yeah, it is choppy. We are in a market of trying to determine what the heck is going on. Are we going to reverse and break out? Are we in a financial crisis and we're going to tank, right? And as soon as it starts to go down, starts to go the other way. Starts to look like it's going to break out, starts to come back down. So if you are trying to force your bias on a particular name, we're in this right now. So your edge becomes after it starts to peak out at that level or after it starts to base at that level. And then we might start to have a trend one way or the other. But right now, we're in limbo. So don't try to force, your bias or what you think should happen, because right now it's not that. What do you see when the market is searching for liquidity? Today, you talked about the low volume swipes to VWAP to sell into. So we talked about that on Friday. Now, the thought process was it's a lot like small caps where, they do these kind of reversals, but each time the volume just gets lower and lower and lower and lower. So at some point, there's two ways to get liquidity. Tank it down to the next level, and then everybody starts to try to play the bounce and there's more liquidity. Or they take on risk and they start bidding it up, bidding it up, bidding it up, and start to bring in a new trend to bring buyers for the breakout, and then use that breakout hopefully as some sort of squeeze into their exit, or just enough buyers to bring back, I guess, interest in liquidity at higher levels. So those are the two scenarios in a situation like this that you want to be aware of. So just be cautious of yes, it's finally, reversing trend. Well, if it's lower volume, lower volume, lower volume, finally reverses on heavy volume and it can't break through a key level, that was probably the liquidity event, right? It's just a hunt for liquidity. And in between, it gets very, very thin. Same thing with the banks. And then the last question, and a good reminder, FOMC this week. How do you protect your positions during Fed decision volatility? Well, You stay aware of it. You stay out of it. You don't trade it. Normally on FOMC, gold and banks go crazy, right? And so you got to be aware of that. And depending on the comments, it could continue a gold trend, either down or up. Depending on the comments, same thing with the banks. Well, we are in a very volatile time right now with banks, and gold is starting to get a bid. So you have to be aware of that this week on FOMC, because those are typically the most volatile products during those announcements. So if they're already volatile for 2 weeks, and then we're coming into this, yeah, you can probably be pretty sure that they're going to be pretty crazy. So be aware of it. Risk off. That's how you protect. That's how you protect during that time. You don't need to have a position into it. You don't need to gamble which way it's going to go. Let it figure it out. Let it tell you. And then take part in it. Or just ignore it altogether until things come into your wheelhouse. That's the secret. Wait for things to come into your wheelhouse, not somebody else's, not what you think they should do. Don't try to be a bank hero and pretend that you know what you're doing, and that you can now all of a sudden read a balance sheet and suggest that it's undervalued. You don't know. Neither do I. So just trade what the market's giving us right now and keep stacking it up as long as you can. And again, like I said in a tweet last week, if you're not good at volatility and you're still pushing buttons and trying to figure it out, that's on you. You can avoid that. So just be aware of that. You don't want to be pushing buttons and getting aggressive in markets that you personally are not good at. For me, volatile markets are great. I love it. It gives a lot of great opportunity. But when a market gaps up and grinds and grinds and grinds, if I'm pushing buttons, that's on me. That's not when I'm good. That's not when I outperform. That's not when I am a good trader. That's typically when I'm very much risk adverse, usually get on the wrong side, start into things, don't scale in, but just waste my day. So I know what I'm not good at, and I know what I'm good at. And when I'm not good at things, I'm more hands-off approach. When I'm good at things, I'm more focused and more patient for those opportunities. But that's that. Let's get into scan for the week ahead. All right, guys. So for the second part of scan, as always, I'm not a financial advisor. These are not buy or sell recommendations, and this is for educational and informational purposes only. If you're not okay with that, shut the video off. If you're good with that, then let's keep on going. Once again, this is to kind of show you what is working in this market, what's not, what I like to focus on, what I like to stay away from. And, I think most importantly, where is the edge and what is the market rewarding at this point compared to maybe last week or the week before. We usually are always right in on, what's working, what's not. We talked about the regionals last week. We talked about national, banks and all that good stuff. And hopefully, the last 20 minutes will help with the week ahead and make sure you guys stay out of trouble. So for me in this current market, I wanted to go over a couple of things just to kind of be aware of. One of the things that we continually talk about is where are we at within the small cap, arena, and are people jumping into the first one and it gets all crowded, or is there 6, 7, 8 small caps going, right? Well, right now we haven't had really a 200% gainer in quite some time. Every now and then, yes, one sneaks through, but we were waking up with continual 40, 60, 80, 100, 200% gainers, multiple, right? And now maybe we have one per week, if that. But when there's only 1 or 2 names that are going, you have to understand that most people can't trade everything else. Most people cannot go from a small cap trading system to some sort of large cap volatility, bank trade, things like that. A lot of people can't do that. So what happens is when there's only 1 or 2 small caps, guess what? Only 1 or 2 small caps is getting all the attention. They're getting super, super crowded, and it's probably not going to happen on your timetable. So this week we had a lot of examples of that because there was only 1 or 2 that were going. There was not 6, 7, or 8, and people couldn't spread out across them all. And maybe one gets crowded, the rest work. It's not that kind of market. So that said, I just want to be super, super cautious with mornings when there's not that many small caps going on. So a quick way to kind of understand whether or not you will run into potential risk later on is whether or not it's breaking down by 10 or 11 a.m. So THMO, perfect example of that. We had that the first day, and these are not in hindsight. This is all real-time stuff that we are talking about in the Traders Lounge ahead of time. And the point is that, I don't want people falling for the same traps that, I typically would in the past. And, when you're not in it sometimes, or when you have learned enough times, you start to see these things. So that's why I start to get very verbal about, hey, just make sure that you've been locking in, because this is not staying heavy where it should have. It should have broken down there, but they caught it, right? And those are all signs. Sometimes in the Traders Lounge, I see people saying, well, I'm going to start in because maybe this time, or, well, it's got to break down at some point. All these different key phrases or triggers, I call them. If I find myself saying that during a trade that's not working, that's to me a sign that I need to adjust. I need to get back down on size. Otherwise, I'm at the, whatever the market's going to do. And if that's a swipe into a circuit, then I'm going to be really upset that I didn't listen to that trigger word that, I heard. And so whenever people do that and say that stuff in the lounge, I always point it out, not to get on their case about it, but just, hey, listen to what you just said. Because a lot of times that's the difference between your cover window. You do have a cover window of maybe could be 3 to 5, could be 15, could be 30 minutes. But once everybody comes to the same realization that, hey, it's not going lower anymore, they all go to the offer at the same time. And that's when you end up with those circuits. That's when you end up with that huge move, huge stuff, and slams right back down. But guess what? You were emotional and you covered at the top. So for me, that's just a time that I need to adjust my size. So THMO, again, we talked about this all real time, but I wanted to give you a little bit of the visual. Then we use the 510 as sort of the consolidation, the support level on this. I think this was Thursday after the raise. 580s from earlier in the day, and also from the prior day. And then 620s being that blowout level. And all this does is it puts a visual kind of game plan together for you. So if you are shorting, say in the middle range, and you're covering over here, a minor adjustment, maybe you don't start in, maybe you only have a starter, but you shouldn't be emotionally taking off a trade into key resistance. Yeah, maybe it could keep on going, but if you're forced out at that level, that means you're mispositioned on the trade. So the idea is just kind of what lines will help you make the correct trade, or at least remind you how to make the correct trade, right? So LiPo is another example. LiPo is one that I think it was Thursday. Everybody is focused on it. But guess what? It was one of maybe two names that was moving that day. So where do you think all small cap players are going to be? Right here, right? So easy fade. That's one thing that I take into consideration. I had a nice trade off this consolidation. They stuffed, faded off, but recognize that it's starting to hold a base at this 233 level. But call it 230s, 235s, whatever you want. I usually round them off instead of going to 232, 233. But point being is, guess what? 10, 11 a.m., we formed a base and it's starting to grind. So could it stuff and slam right through? Yes. But is it worth having full size on and then get in a situation where you emotionally cover into the top end of the channel? And you can see how the top end of the channel stuffed right here and then just came apart. Same deal, ENZ. ENZ on Friday. Had this conversation in the room. 196 we knew pre-market was key. They gave us that information. And then after that, we had twos starting to base. The fact that it did not break down after that should trigger something that says, hey, maybe I shouldn't be sized up waiting for this trade to work for me. Because if it doesn't, guess what? You're probably going to cover into this. Then you get upset. Then you re-put it back on because you covered like a chump into the ramp. So then you're upset. Meanwhile, it never broke back under this key level, under VWAP. And then you stop out a second time emotionally because you were upset that you got blown out here. You didn't want to miss it, so you slammed into the weakness here. and then you just doubled your loss because you were emotional. So putting these things on your chart help you with a little bit more visual representation of what to do and what not to do. So hopefully that makes sense. And again, these are all real-time examples. Obviously, right now I'm doing it in hindsight, but these are things that we talk about real-time as it happens because I've been there a million times and I've learned the hard way a million times. So let's get right into it. Main watches. Main watches is basically where the most liquidity is, where I'm going to be focused. And that could change by, Monday morning. It just depends on what banks are doing, right? It depends on what the market's doing. We've got some pretty not so great headlines this weekend so far on the banks. So is that going to bring us to a 300 or 500 point gap down and a 10% pullback on banks, 30%? Who knows? But it could change by the morning. However, main watches. Bank of America, I put this into the same basket as say, Schwab, Citigroup, JPM. So these are all, when I say Bank of America or Schwab, I refer to the entire index. And I will pull up all four to see which ones have good liquidity that day, good range, good trend. And then I'll usually focus on the top two that fit my personality. So anyway, react to trade off this one. We'll see what happens, but there's no real sense coming with a huge plan. Usually I like to see it go back, retest towards the prior day's VWAP, and then fade off from there. But we'll see. It's going to probably be a gap down. I wouldn't be surprised to see this 26, 27s. And then we'll pick it up from there. Bitcoin had a nice move this weekend. This one thing I wanted to discuss. So whenever I say Riot or whenever I say Mara, you should assume that I'm probably going to spread it across to all of them, coin included. I always like to, if I have a high conviction trade, I like to put all my risk across multiple names instead of just maybe one name, because you never know. If you have single name risk and you keep on sizing up, maybe you take on more market risk, but you also take on headline risk, the potential of one PR that comes out that could, move that particular name individually. So I always like to spread it out. So anyway, with Riot and Mara, there's two edges in this type of trade. One kind of showed at the end of the day over here where it basically was ramping into the close and it came off. And same thing with Mara. I traded this one actively on Friday. But when Bitcoin's going sideways or up, if you're shorting this trade, then you have to be. It's really a proactive. You're reacting to the move. You cover into the flush, and it's scalp mode. Something that I don't typically like to do. If Bitcoin's coming down, then yeah, you're going to be patient. And as long as Bitcoin has outlier range, if it's down, say 1,000 points, 1,500 points, all these premiums are going to shave off. And you're going to have a nice, steady outlier type of unwind on the trade. So those are the one edge, right? Either joining the trend, either direction. The second edge on this is, for example, Bitcoin, which was flat into the close for the most part over the last hour on Friday. Meanwhile, Mara and Riot were going up. So as those exhaust out, that's when the edge comes in, because it's almost like a mean reversion type trade. There's probably been a lot of traders that were on the wrong side intraday on Mara and Riot. So they're reacting before close. Meanwhile, Bitcoin does not agree. Bitcoin's just like this, Mara and Riot taking off. So there's going to be an edge where that slams back down, more than likely. Not always. It's the market. There's risk. But more than likely, at some point, if it exhausts out, there's going to be that edge. And that's exactly what happened on this particular trade, Mara and Riot on Friday. And that's what gave a good opportunity. Right. All right. So, and you can also see Coin did very similar as well. That said, Bitcoin was up big. With all this banking crisis and all that kind of stuff, it's been getting a pretty good bid. So don't underestimate it. Just like last time, it can stay stronger than you think, longer than you think. Just got to go with the flow. Last two on main watches, CRBP and AMD. AMD has been a super, super clean trader if you want to trade it actively. Pretty wild moves. This entire setup was fantastic, but like I said, I started early on a starter, no problem. Had great entries, 96s, covered 95.40s, 96s, covered 95.40s and 94.50s, but held the batch because I was biased and grinds me all the way back up. So I did all this work for nothing. Had I wanted to get on the right side of the trade, just one line across until it breaches and stays under, I don't have a trade. I don't have a trade to be patient on. So, again, this is just an example of just draw those lines and behave. It's no problem if you have a starter on it, but just behave above it if you are trying to find a trade. But you can see just how back and forth this thing was. It's a wild trader. There's going to be a big trade. This is what happens. This is kind of like the battle at the top. And are we going to go another 3 to 5 points, or is this sort of the exhaustion move and then it's going to start to come in? So tech's been super, super strong. Be cautious with that. But that one in CRBP, same deal with the lines again. 670 was the level that I gave in the room. So if you are shorting prior to that, if you were, for example, this right over here, this blowout, I participated in, but there's no reason to participate unless you're covering 670s. So as you saw, I covered the 670s. We had another one, and then this time, instead of peaking out right there, they blew everybody out that was using that prior top, and then the trade came in, and I saw some phenomenal folks tweeted me with their trade on this thing, being patient and waiting for that blowout. So that was really nice to see, and I was happy to see that. So good work on those. Next up is failed follow-through. So failed follow-through, it does not mean I think everything's a short, but what I'm looking for is some sort of push-up, some blowout, and then an edge. What does that look like? Well, we just saw it on CRBP. You just saw it right over here, blows out, and then failed follow-through momentum. You saw it on THMO, the blowout, and then failed follow-through momentum. You saw it on the day before. If I can get back there, where you've got some blowouts and then failed follow-through, blowout, failed follow-through. That is what failed follow-through momentum looks like. So ENZ, where would be the good level? Well, I would love to see it pop up, back up over 240s, 235, 240s, blowout. Let's use a whole and half dollar mark. 250s blowout would be ideal. But in the ideal zone, I'd love to see it ramp up towards 240s, exhaust out, and fail to follow through. In this case, it reminds me of one of those days where shorts come in, they start to scale, they're patient, and then they cover before close. So typically what happens is maybe the market's not going to be there. And so any good morning move is just going to be faded off because all the shorts covered on Friday. THMO, I think we're going to be lacking liquidity, but it might be worth a little bit. So any pops for failed follow through would be ideal. HSTO, watch dips, and I think you should be cautious until it's over maybe that 150, 145, 150 level. So yeah, 50 million shares traded. Volume is very important to me. Watch if this has either 130, 140 kind of base and starts to ramp, but be cautious believing your own bias until it's over this prior resistance area. We had CIFR, daily looks pretty good, CIFR, and that one ramped up, came back down, and then we have the wicks. And it's actually had two big clear out moves. You had one over here, came back in. You had one over here, came back in. So when it ramps up like this, it sits back down on volume, and then it starts to have the wicks after. You know that this probably cleared out a whole bunch of longs and trapped a bunch of shorts. And now we're going back up and retesting that. It could have some longevity. So that's what I'm looking for there. CDTX, like the daily, nothing I'm excited to join, but I just want to stay familiar with it. And the last two, BXRX, possible liquidity trap here. So you had about 10 million shares traded, and then you had about 1% of that the following day. So excuse me, 10% of that. So watch, especially if it's only got a couple 100,000 shares. And the most important part is not to assume that it has to do anything. But if it starts to trade over those 190s, that's when you want to pay attention, right? So don't assume that it's a liquidity trap just based on going from 10 million to a million and then it's day 3. What you want to see is it over Friday highs in order to start getting bullish about that. And remember, if the squeeze comes, if the volume comes and there's a shift, right? If it swipes, volume comes and it stays heavy after that, that was the cover. So don't force your thesis that it's a liquidity trap. It has to keep on going. The liquidity traps play out if there's no cover that comes in and it just slowly is like a perpetual squeeze. And last but not least, ELEV, which is sort of the same concept that I was just trying to explain. You got this huge volume day over here, 29 million volume. Next day, you've got less than 10%, 2 million. And then after that, you've got half of that as well. So if this is holding dips again, we might start to have this 20 million share day blow out in a T+2 kind of cover situation. So that, I think, is it. I will pick another additional winner next week from this week's scan just because back up to the beach and I didn't pick one beforehand. And my video guy is out this weekend, so I don't want to make it overly complicated. That's it. We'll see you guys in the room. And again, watch the YouTube channel tomorrow for Kim and Curtin interview. And then again, for IU members, we have the entire thing coming by Wednesday.